Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from ChartsandMarkets.com runs down the major markets. More record highs were hit, and so were some exhaustion points that indicate there could be a major correction on the way. After a strong spring, crude could show weakness in July. Ross also has a special offer for our listeners. Untitled.Trading.com President Eric Hadik takes a look at how important cycles are for trading with some insight into interest rates, bonds, gold, silver, and the U.S. dollar. Author of several books on the economy, including The Money Bubble, John Rubino examines the move by the BRICS to kill the U.S. petrodollar and bring in their digital currency that will be partially supported by gold. John also looks at how troubled commercial real estate could hit the U.S. banking sector. We'll talk to Ross Clark right after this.
Recyclico, making lithium-ion last forever. Recyclico's patented recycling process achieves up to 100% recovery of battery metals from lithium-ion batteries for electric vehicles, including cobalt, lithium, nickel, manganese, and aluminum. Recyclico Battery Materials Incorporated trades on the TSX Venture AMY, on the OTCQB AMYZF, and Frankfurt ID4. For more information, visit recyclico.com or phone us at 778-574-4444. Recyclico, making lithium-ion last forever.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from ChartsandMarkets.com, where you'll find insightful market commentary and timely technical analysis. You can find him on X at Charts by Ross. Welcome back to This Week in Money.
Well, it's a good way to start off the summer here, and, we've just passed the longest day of the year, and now we're into what should be more of the hot ones.
Ross, do we have a special offer for our listeners?
Yeah, for the new full-time subscribers, if somebody wants to go to the homepage, chartsandmarkets.com, there's a 25% special there for anybody taking out a new annual subscription.
Ross, how would you describe what happened on the stock markets this week?
Well, we got some more record highs again, but we're getting to the point of some what I determine to be new exhaustion points, and we've had a series of them along the way. But the Nasdaq managed to put in on a daily chart a good exhaustion high this week. Ended up with. This signal is not too often. We get on average once a year. We've had 27 in the last 25 years. So there's a pretty good chance that we see a correction back to either the 20 or the 50-week moving average for the NASDAQ. And, the driving force behind so many of these weighted indices has been NVIDIA. And NVIDIA produced, as of Thursday, or as of Wednesday's close, what we call a trifecta. That's when we get exhaustion signals on the upside on the daily, weekly, and monthly charts, and they're all simultaneous. If you get them at very different times, they don't really, they can produce minor corrections. But by the time you get them in all three time frames simultaneously, the chances of a good correction really start to come out to the horizon. And there's only two other examples in NVIDIA going back over 25 years, and the two previous examples produced basically double tops. You went through a rolling process over the next 2 to 3 weeks, retested the highs during that time frame, and then eroded away a bit. So NVIDIA, which is trading around, 126 at the end of the week, having been up to 140, could easily get back and test the highs that we had in Q1. That could take quite a while, and probably we'll have a lot of positive news and stories along the way, and the key will be to see how the stock reacts to the new stories that come along, and I'm sure there will be some, but we want to be cognizant of the fact that this upside move really got overextended at this point. We have, as we've been mentioning, a real discrepancy when you look at the advanced decline line. You look at the Dow theory, where the Dow transports have been underperformed significantly relative to the Dow industrials. And when you get divergences like that, and the AD line, advanced decline line, is faltering, you put a whole series of these sort of rules together, and we ended up with a Hindenburg signal this week. Actually, we've got a confirmed Hindenburg, and that means that there's a pretty good chance of not just a minor correction, sort of in the 5 to 10% bracket, but it could be bigger than that as we move into the fall. So an item to be wary of. As we've noted, the S&P 5,400 to 5,600 was a major upside target for us based upon the 100-year chart that we're monitoring. And it's seeming to do, at this point, some backing and filling, even though it had its, third week in a row on the upside. It was losing momentum at the tail end of the move.
What's going on with gold?
Pretty big swings the last few days here. It ran up hard to $2,360 in the middle of the week, and then faltered on Friday. Outside reversal, made a marginally higher high than it had earlier in the week, and then closed below Thursday's low. So you got an outside reversal there. You got the same thing in the silver market. And we've been watching the U.S. dollar index as one of our key indicators moving through the last month or so. The strength in the dollar index, it runs in a nice cycle, and we've put out some research on that. It is due, from what we can see, to probably top out during July. And at that point, hopefully, we end up with a good low as far as the gold and silver markets are concerned. Now, gold did produce a nice measured top and sequential signal back at April at the highs. And what we have seen historically is that corrections after that move pull back to the 20-week moving average. And it can take a while to get there, and you get a little bored sort of waiting for it. But the fact is, with patience, that support tends to be tested over time. And right now, the 20-week moving average is at 2260. Current price is around 2360. So if we were to get a good break into the month of July, could be a pretty good buying opportunity for not just the bullion itself, but also the stocks.
What's happening with crude?
Crude, originally that rally off the bottom looked as though it might have resistance up around 78. It did push quite a bit higher here. We got up to $82 this week. And that now is retraced a Fibonacci 61.8% of the decline we had from earlier this year. And it's a sequential 9 signal on the upside. So it's been 9 consecutive days with high close is above 4 days earlier. And 90% of the time when you get that signal in the crude oil market, it will correct back down. So at this point, I think there's a pretty good chance that this rally has run its course, and we could look for a poor July. And historically, if we look back, there's a few Julys that do all right. However, when you've had a really good May, June, as we have had, then July tends to be a poor month. So if you're looking for an item to possibly be short, crude oil would be on the list of items to keep an eye on.
What's happening with the U.S. and Canadian dollars?
U.S. dollar has closed off this week at its best level in over a month, and that's right in line with the cyclical work that we've got. So we're just short of 106 on the dollar index. And actually, if you look at the UUP, which is a broader-based index of the dollar, it closed at new highs for the year. So seeing some pretty good moves over there. Canadian dollar, a week ago, we got the commitment of traders numbers, and those showed that the net speculative short position was at the greatest level in this century, literally going back to 2000, as far back as we've got the data on that. And the commercials had the largest net long position. So the Canadian dollar, from just the perspective of the overcommitment of the specs, would imply that there might be a bit more buoyancy as far as the dollar is concerned.
Ross, thank you so much for the update.
Good to be with you, Jim.
My guest has been Ross Clark from chartsandmarkets.com. You can find him on X at Charts by Ross. Coming up, Eric Hadik next on This Week in Money.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. Always consult your investment professional before making any investment decision. This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Eric Hadik, CEO and President of InsideTrackTrading.com. He's speaking to us from Central California. Welcome back to This Week in Money.
Well, thanks for having me back, Jim.
Eric, you place a lot of focus on cycles and their impact on the markets. Can you explain how you use them?
Yes, that's always a good question. And probably best is to start by defining cycles as far as my application, my definition of them, so that readers and listeners understand the perspective that I'm bringing to it. When I speak about cycles, I'm talking as much about the recurring and consistent intervals between more extreme events in the markets and even in the world around us. So kind of the peaks and valleys in the market, peaks and valleys in related economic and geopolitical cycles. That is where the majority of my focus is, looking for those extremes, looking for those transition points. Whereas a lot of people that talk about different cycles in the world, in societies, they're kind of talking about the entire progression within a particular time period. I'm primarily focused on looking for those extremes. So when it comes to the market, it's looking for those consistent intervals between significant highs or significant lows in a particular market, and then applying them to the overall analysis that I use. One of the tools that I developed a couple decades ago that I use a lot in identifying that is what I call a cycle progression, and it's built on the underlying theory hypothesis that cycles in the market will apply to or govern successive lows for a certain amount of time and in a certain part of an overall wave structure. But then when you get into the breakout accelerated part of that trend, that wave structure, the cycles will actually invert and start to time a succession of highs. And so this cycle progression tool helps me to kind of focus on those progressions, and when successive lows are expected in a given market, and then ultimately when you will see that invert and start to time successive highs. But even saying all of that, it's also important, it's probably the paramount consideration that I apply and that I communicate to my readers, is that cycles are merely the backdrop. They are setting the stage for far more specific tools in analyzing and ultimately trading the markets. I use those cycles to set the stage, to give me time frames when I think the market's reaching an extreme. And often that is, if I'm looking for an impending high in a market, that's where I'm looking to be exiting long positions, not immediately initiating short positions. And there's reasons for that deal with money management, that deal with technical indicators. But so those cycles give me some timing of when to expect some of these trends to start to wane, and some of the technical indicators that I use to indicate the extreme of a move to start to kick in. And that's where I implement cycle analysis, and that's when I also kind of hand it off from the cycles to first primary price indicators that give me trigger points, and then confirming indicators that follow that up and validate what has been shown by the initial indicators. So it's to get back to the original question of cycles, it's a measuring those intervals of time between extremes in the markets, but then using that as a backdrop for more specific and more objective technical analysis in the markets.
In March, you discussed the natural year and what you called the date of aggression and predicted a quick stock market sell-off. Does that still have any impact on the markets?
Yes, it definitely does. And just to refresh your listeners' memories, back in March, I was explaining how I view the markets from a couple different perspectives, but one of them is applying the natural year, the year that governed agrarian societies and still does for thousands of years, and the year that still does have an impact in many respects on key markets. And that is a year that begins with the vernal equinox, the start of spring, usually March 20th, 21st. This year it was the 19th, 20th because of the leap year, and flows through to the following vernal equinox. But in line with a focus on opening ranges, that in the markets, the opening range is often a very important time frame because it's the digestion and distillation of a lot of information and data that has preceded it in the markets. It used to be even more so when the markets were actually closed at some point during the 24-hour day. But it would be the accumulation of things that had occurred since the previous close. And so then the opening range was a very important, like I said, a digestion and then a response to what had gone on up to that point back in the 1980s and flowing through the current time. But you had approaches to analyzing the markets like market profile that placed a lot of emphasis on the opening of a trading day. But anyway, getting back to my primary point, I view opening ranges as very critical on different time frames, and one of them is on a year. And so the opening range I define as the first month of the year. In the context of this natural year, that is a 30-day period that lasts from the vernal equinox to April 19th, 20th, a date that I call the date of aggression. And I go into that in a lot of other discussions, but it has been something that has timed conflicts and attacks and battles throughout the centuries and been very impactful on America as in the last couple hundred years. But that first month from March 20th and 21st and April 19th, 20th acts like a gauge or a litmus test for the remainder of that natural year. And you will often see markets give an initial move during that time period that sets the stage for the ensuing or subsequent 11 months of that natural year. And even in the stock market, if you look at the last 4 or 5 years, and it's kind of alternated back and forth where the market will give a good rally during that time frame, and that kind of sets the stage. In fact, you go back to the depths of the COVID sell-off, and when did the markets bottom? It was right around March 20th, 21st of 2020, and then they saw an initial surge into the second half of April. That set the tone for what was going to follow, which was an extended recovery and rally. And each year you've kind of seen that in different degrees. But because of a lot of corroborating cycles, I thought that 2024, that time frame would be more significant and more telling as far as what the market is setting up for the coming months. So all that to say that a lot of my other work was already indicating to me that stocks should see a quick, sharp sell-off, roughly from March 21st into about April 19th. And as I said a few minutes ago in discussing cycles, it was a lot of other technical indicators that were kicking in just before then, and then as it was unfolding, that were convincing me and triggering sell signals that I thought should be heeded. But that's the primary expectation and importance for that time frame, that sell-off. But the secondary, overarching, perhaps more important application of that is what that opening range tells you about expectations for the coming months, and also how it sets parameters for the weeks and months that follow. And so if you look at many of the indexes that typically lead turning point in the market, and by that I'm referring first and foremost to the Dow Transportation Average. That is an index that often turns months before the rest of the market. So it gives you some of those early warning signs. The Russell 2000 is another one that has consistently turned, particularly turning down from significant peaks, but also at the lows. And that often turns months before something like, say, the NASDAQ 100, which is usually the strongest and the last one to peak in any cycle of the markets. And so you had the Dow Transportation Index, the Russell 2000, the S&P Mid-Cap 400, even the Dow Industrials. They all had that sharp drop into April 19th, and so did the S&P and the NASDAQ. But those other four, that set an opening range that has, for the most part, not been broken out of yet on the high side or the low side. The transportation average is now starting to break below the April 19th lows and start to show some weakness. But that's almost like an initial decline, some sort of A wave of a larger ABC correction. And it sets a very decisive support level, that being the April 19th low in this case, for the subsequent months. So I'm looking at that as a very determining level of support for a lot of these indexes. And I think it can be broken to the downside in some of them. And that would reinforce the idea that we're into a corrective phase, particularly in the weaker leading indexes. And that April 19th low will probably act as support that's not broken in the S&P 500 and the NASDAQ 100 if they are to remain in a bull market. So it's not just the move that was anticipated during that time frame, but it's what the extremes of that move show you going forward. And even when I mentioned some of those weaker indexes, a couple of them went back up to their March 20th, 21st highs and held that as resistance and turned back down. So it just reinforces that whole theory or that whole idea that we've set an opening range, and that opening range is acting as key levels of resistance and support moving forward.
Bonds have been slowly rebounding since late April. What's your outlook for interest rates?
I am still looking at bonds as being in a very slow, steady recovery mode from their October 2023 low. They suffered a very sharp 3-year sell-off, and it's the type of thing that usually a market takes a long time to lick its wounds from a drop like that and to set up for any previous declines that might be on the horizon. And so bonds have been in this recovery mode. Of course, interest rates appear to have peaked, but every time that everyone thinks there's signs that the Fed should be cutting them soon, all of a sudden another sign comes out and says, well, not yet. Inflation still isn't near that 2% threshold, and there's still signs of life in the economy. And so they keep pushing back farther and farther where they think that the first rate cut will occur. But from the perspective of bonds, which trade inversely to interest rates, I've been saying all along that I thought they would see a recovery the last couple of months into early July. And depending on if a couple of indicators are triggered at that point, it could ultimately stretch into early August. But that's where, on an intermediate basis, I'm looking at bonds. I think on a bit broader basis, that the entire recovery from October into third quarter of this year, wherever that ends up peaking, that recovery might just be the first rebound in a broader, what I can only call an ABC upside correction. So that's all of that activity from October through July or August becomes the A wave. Then you see a sell-off in bonds that holds above its October 2023 low, and then you see another leg to the upside in 2025. That's kind of what I'm looking at from a little bit broader basis. That's probably not, huge amounts of excitement other than some random couple day spikes one way or the other. But I think that bonds are going to steadily be recovering in the coming weeks, and then on a little bit broader outlook.
Does that have any impact on your outlook for the U.S. dollar?
It is probably going to have an impact, but there's a axiom that I use and repeat a lot to my readers, and it has to do with market correlations. And the gist of it is that when you're looking at two markets that are often correlated to one extent or another, and you kind of have established what might be the leading market, those correlations really only hold strong during the extreme portions of a trend and of a market cycle. So when there's either breakouts of key support or resistance levels, and or when there's acceleration, the upside or downside, is when you see those correlations hold pretty true and pretty consistent. In between, you're in more congested markets, and the two are, kind of looking out of their peripheral vision at the other one, the dollar towards interest rates towards the dollar. But there are a lot of more immediate concerns and influencing factors that are impacting those markets on day-to-day and week-to-week basis. So while I do think that the interest rate outlook is going to have an impact on the dollar, I think you're seeing a lot of divergence from what would normally be considered the straightforward correlation that higher interest rates attract money into the dollar, and so that strengthens the dollar. The other thing about that axiom and that correlation that I should mention is that it's also very important to know which market is leading the other at any point in the trend. So whereas I just mentioned the one correlation where higher interest rates can lead an uptrend in the dollar, if there are other factors other than interest rates impacting the dollar more convincingly, then you could have the dollar leading interest rates, and if the dollar is gaining, that might ultimately be the impetus for lowering interest rates. So it's important to know which market is leading and which is lagging in that correlation to be able to really apply it accurately. I'm looking for the dollar to right now that I think it's in a recovery mode from its initial sell-off, but I think that once that recovery is complete, you're going to see another pretty sharp sell-off leading into longer-term cycles that I'm looking at in 2025 and 2026.
Gold and silver have traded sideways for several weeks. Could another upside breakout be on the horizon?
I would have to answer that in the context of what I have been looking for and discussing and writing about for the last at least a year now. And the primary conclusion in my longer-term analysis and now my intermediate and even getting to short-term analysis has been that July of 2024, next month, would be a significant peak in gold. And I started writing about this back in May of 2023 when gold was fulfilling the latest phase of a 14-month cycle that it was adhering to. And this is another application of what I was describing in my utilization of cycles in the beginning of our discussion here, where I'm looking for those extremes, the intervals of time between significant tops or significant bottoms. And so gold had and still has a very significant 14-month cycle between peaks. And when it set its high in May of 2023, it told me to look for several months of corrective action where that peak wouldn't be exceeded for some time, but it would also be part of a series of ascending highs with the next one on that particular cycle interval coming into play in July of 2024, 14 months after the May peak. When you have cycles like that, especially when they are heading to more of a culmination phase, you'll also see them break down into their midpoint or half cycles, and then even the half cycle will often break down into its half cycle and provide what are corroborating intervening peaks. And what I mean by that is if you've got a 14-month cycle and it just peaked in May of 2023, and I'm looking for a future peak in July 2024, one thing that would strongly corroborate that is if an intervening peak is seen at the 7-month point in December of 2023. And what that would do is create a 7-month cycle between the highs and project a future top for July of 2024 if a top was seen in December of 2023. And that's exactly what we had in gold. You had the initial surge from the breakout of war in Israel in early October, and that carried gold up into early December when it set a multi-month peak. And so that just reinforced this July 2024 cycle. There have been a lot of other cycles and other timing indicators and other factors that have just continued to intensify my focus on July of 2024. So as we're coming into that, I do think that gold has the potential for a final spike high, but I think it's far less likely for it to see a lot of carryover to the upside. So as far as an upside breakout, I think it's more likely we would see an upside spike high, but that would then time a pretty significant peak in gold. And at the same time, I've explained why silver has, they're not nearly the same cycles, but yet they're concluding almost the same thing, to look for a peak in the case of silver. It's early July that has the greatest synergy of these cycles all coming together. So it certainly looks like we could see a final spike up into that time frame, but at this point, I don't see much that would tell me to look for a lot of follow through if and when we get that spike high.
Eric, where can people follow you and subscribe to Inside Track?
Well, the best way to do all of that is through our main website, Untitled.Trading.com, and that is inside spelled with the extra I in the middle. So it's INSIIDE, tracktrading.com. They can get a lot of information, a lot of archived reports, and many tutorial type of articles and reports there that explain a lot of the indicators we use, and also information on our publications and how to subscribe to them.
Eric, thank you so much for being on This Week in Money.
Thanks for having me back, Jim. It's been my pleasure.
My guest has been Eric Hadik, CEO and President of InsideTrackTrading.com. Coming up, John Rubino, next on This Week in Money.
Recyclico, making lithium-ion last forever. Recyclico's patented recycling process achieves up to 100% recovery of battery metals from lithium-ion batteries for electric vehicles, including cobalt, lithium, nickel, manganese, and aluminum. Recyclico Battery Materials Incorporated trades on the TSX Venture AMY, on the OTCQB AMYZF, and Frankfurt ID4. For more information, visit recyclico.com or phone us at 778-574-4444. Recyclico, making lithium-ion last forever.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is John Rubino, author of several books on the economy, including The Money Bubble. He founded the website dollarcollapse.com. You can find him on Substack at Rubino.substack.com. Welcome back to the show.
Hey, Jim. Good to be back.
A story about Saudi Arabia canceling the petrodollar is going around. Should it be taken seriously?
Yes and no. That was kind of a, I don't want to say false news. It was a thing that just was misinterpreted, basically, by me as well as lots of other people out there. Saudi Arabia and the U.S. had a cooperation pact that they signed back in the 1970s, and the Saudis just let it lapse right now. And a lot of people misinterpreted that as them basically canceling the petrodollar agreement, which isn't what it is. The U.S. and the Saudis are working on a new deal to replace the one that the Saudis let lapse, and so that they're going to be allies, and they're going to cooperate on lots of things going forward, according to what they're trying to accomplish now. Now, having said all that, though, one of the agreements way back when called for the Saudis to only take dollars for oil, and they've basically abandoned that. Now they will sell oil for other currencies now. So the petrodollar as we knew it is dying, and the fact that Saudi Arabia has joined the BRICS coalition, which is kind of sort of an anti-dollar coalition, means that the Saudis are going to be not necessarily on the dollar's side going forward all the time. So I think the de-dollarization trend is still intact. It's still moving forward, and the BRICS countries are still buying lots of gold. They're still discussing ways to create a trading currency that they all use when trading with each other in place of the dollar. And, all of that stuff is happening. And none of it is good for the dollar. And it's just a question of timing, really, how quickly the process comes to fruition.
Well, the BRICS are talking about a gold-backed digital currency where about 40% of that currency would be backed by gold, the other 60% their fiat currencies. Is that workable?
It'll be tricky, but yeah, that is what they're working on right now. They're all working on, individually, they're working on central bank digital currencies. And the idea is that there's a gold-backed trading currency that is tied into these national central bank digital currencies. And they're all able to trade that currency back and forth and basically understand what it is, know it's backed by gold, understand that it will hold its value because of its gold backing. And, it's an attractive idea. Getting the BRICS countries, many of which are dictatorships, to cooperate and then to trust each other after a deal is struck that's a complex prospect, so no guarantee they're able to do that, but they're heading in that direction. And they have this kind of the enemy of my enemy of my friend thing going now, where they're all the enemies of the U.S. right now. Everybody's frustrated with how the U.S. has weaponized the dollar reserve currency, and they would like to be able to bypass the dollar. And this is one of the things that they're looking at doing. And they do have an incentive to make it work because they're so frustrated with the U.S.
China's central bank didn't buy any gold in May. How do you interpret that?
We'll have to see. 1 month doesn't really matter in the scheme of things. And China bought gold for like 18 months straight prior to May. And then the price of gold was up quite a ways in May. So it's possible that China just figured, hey, let's not buy anything for a month and see if that makes the price go down before they resume their buying. Or it's possible that they're done with the current buying program, and that's it for a while. We'll have to see. But generally speaking, central banks have been net buyers of gold for quite a while now, and there isn't really anything happening out there other than gold having a higher price in dollars right now. There isn't anything happening out there that seems likely to change those plans. There was a survey just lately by the World Gold Council where they found that 65% of central banks expect to have more gold in 5 years than they have today. So that doesn't say anything about the coming months gold buying, but it does mean that their general perspective is a higher balance of gold going forward. And I think that's a reasonable way to look at it. You can't know what's going to happen in any given month, but the general trend is still for central banks to be replacing a lot of the dollars in their reserve assets with gold, because gold is a neutral asset. When you own gold, you're not making a political statement. You're not choosing sides. And that's very appealing right now.
Gold and silver have stalled lately. Is this seasonality at work or something more?
Yeah, that's an interesting one, because the seasonality thing with precious metals, it fools me every time, because basically the way it works is gold and silver tend to go up in the winter, which is when Asians do a lot of their buying ahead of springtime weddings, when they want to give gold and silver as gifts. And so everybody gets excited, including me, and thinks, okay, January was strong and February was strong. Maybe it'll just stay strong for the rest of the year. And then May and June come along, and the old saying, sell in May and go away, turns out to be true, and gold and silver go back down some, and we're kind of seeing that again here. I'm not saying that seasonality is the only factor at work, but I am saying it's the same pattern that has fooled me for the last 10 years. So it's very familiar, and in that sense, it's not really scary. What would be scary is if October rolls around and gold still goes down, because normally that's when the winter buying season kicks in. So if the summer is boring, most summers are boring, no big deal. And if winter is exciting again, that'll be awesome. I'll take that pattern by and large, because it is tended to be repeating within an overall uptrend for gold and silver. So if they want to stay with that kind of a pattern, I'm all for it.
How important is the rise of the Shanghai Gold Exchange?
Yeah, it's a potentially interesting thing. You know, Jim, you and I have been talking for years about how someday the physical market is going to take over from the paper market, and then once physical demand sets the price is going to be a lot higher. Well, we're seeing physical demand start to take over for paper because of the Shanghai Gold Exchange, which is a fairly new metals exchange designed for physical trading. In other words, you can order gold on that exchange and you'll get physical at the end of the process, instead of like the COMEX where you're basically playing with paper futures contracts. Well, the fact that the price has tended to be higher on the Shanghai exchange than in London or New York or Chicago has led to an arbitrage where you can buy gold in London, turn around and sell it in Shanghai and make the difference because it's higher in Shanghai than it is in London. And that's leading to a lot of gold migrating from the west to the east. It was already doing that, but now it's doing it at a faster rate. And that's a potentially big deal because the fact that the BRICS countries, I guess we're going to go with that grouping now, they've been accumulating gold for a long time and silver. But if now they've got a mechanism that allows them to accumulate it even more quickly, that's a big deal, you know. And it's a big deal to the West, where gold supplies and to an even more extreme extent, silver on these Western exchanges, the supplies are starting to fall to the point where people are starting to worry that we're just flat out going to run out of physical silver for our needs here. And if that happens, then you get a deficit turning into a shortage, turning into panic buying, turning into a parabolic rise in those metals prices. So pay attention. You know, we could be in the early stages of something like this that over the next couple of years gives us another 1979 or 2011 kind of move in precious metals, which is to say basically straight up for a while.
Walmart, Costco, and vending machines in South Korea all handing out gold or selling it. What kind of an impact does that have on the market, or is the retail market too small to have a big impact?
Well, it's nice to see retail kicking in. I mean, it's a smaller market than the central bank buying is, because central banks have effectively unlimited amounts of money to throw at something if they want to. But it's not chump change either. Costco is selling a couple of $100 million worth of gold per month, which is a couple of $1 billion a year. You know, that's a serious number in relatively small markets like gold and silver. And these Asian markets where they're doing unusual things like selling gold out of vending machines and stuff like that, there's a lot of free cash in societies like that. And to the extent that people want to put their free cash into gold, that's a very good thing. For instance, in South Vietnam, the central bank actually had to sell some of its gold in order to take the heat off of the demand in the private sector for gold, because they were raising the price too rapidly relative to the rest of the world, and that kind of spooked the central bank. So they dumped a bunch of their gold on the market to bring the price back into balance. Stuff like that is good for precious metals. So another thing that's happening is that the Chinese gold and silver ETFs are starting to grow again. They're starting to accumulate ounces. So you've got demand from different parts of the global economy all kicking in at the same time, and that can't help but be good for gold and silver.
Is the banking system past its balance sheet crisis, or is another round of bailouts imminent?
No, I think the banking sector it hasn't seen its real trouble yet, because the commercial real estate market in the U.S. is in trouble and getting into deeper and deeper trouble as more and more office buildings are sold for massive discounts to what they sold for last time around in 2014 or 2018 or whatever. Those embedded losses have to be taken by somebody, and a lot of those losses now reside on the balance sheets of local and regional banks. So let some local and regional banks start taking some big losses because of commercial real estate, and you'll see a panic in that sector. So we haven't seen anything like what's probably coming, and it's liable to end up forcing a bailout on the part of the federal government of the banking sector in the U.S., and that's multi-trillion dollars if it happens. And it makes you wonder what happens to the dollar if we keep having these big bailouts.
Earnings season will start in mid-June. What do you expect for the precious metals miners?
Yeah, I think this might be a pleasant surprise for a lot of people because no one's paying any attention to this. But the gold and silver miners in the second quarter have been selling their metal for a much higher price than they did a year ago. So just to take an example of how it might work, let's say you're a gold miner and you're selling 5 million ounces of gold a year. Well, if the price of gold goes up by $200 or $300 an ounce, that is 5 million times 200 or 300, which it's an extra $1 billion. And that's just right there on the top line for a miner like Agnico Eagle or Newmont or Barrick. So these guys, to the extent that they're able to control their costs, are going to see a big top line go straight down to the bottom line and give them a big percentage increase in earnings this quarter versus a year ago. So I don't think anybody's factoring that in right now. People just aren't paying attention to the precious metals miners. And because of that, I think there might be some pleasant surprises when some of these earnings come out and they're stronger than expected, or stronger at least than individual investors expect. And that's the kind of thing that feeds on itself. Once people start expecting big year-over-year gains in margins and earnings and dividends and all the rest of it, then all of a sudden that sector becomes really attractive to generalist money. So we'll see how it goes, but I think Q2 earnings are going to be very interesting. They're going to come out in July and August, so the summer might be more exciting than it normally is for precious metals this time around.
Buy now, pay later is spreading to multiple platforms. Is this a convenient service or a trick to create more debt slaves?
The latter. Absolutely. People are already over-indebted. There's a record amount of credit card debt out there. There's a record amount of personal interest expense that has to be covered by American consumers. But the credit industrial complex isn't satisfied yet. They haven't created enough debt slaves out there. So they're coming along with this new twist on an old thing called buy now, pay later. It's a twist on layaway buying back in the day. You used to, your wife wants a new dress, she buys it, and the store holds on to it until you guys make your payments to cover it, and then you get to take the dress home. Well, now you get to take the thing home right away, and then you have to pay for it in equal interest-free installments over, say, 4 months or something like that. Well, it sounds like a convenient way to do it, but what it actually is just another way to get people who are already maxed out on their credit cards to take on more debt. And, I think it's part of a plan, frankly. The credit card companies and the other big finance companies are always incented to get people to borrow more money. But I think there's a broader plan at work here to get us as deeply indebted as possible and make us easier to control in that way. Because once they've got a central bank digital currency, and that's where your account is, and you owe a ton of money to the credit card companies and to these buy now, pay later companies, and yada, yada, what the government does with your bank account becomes incredibly important to you, and you're willing to sacrifice freedom in return for financial stability in your life, and that's what they want. So I think the buy now, pay later thing is part of an evil scheme, and we should be paying attention to it because of that.
Where is the best place for people to follow you?
I'm at Rubino.Substack.com, and I run a newsletter there that's mostly free, and it has a few specific investment advice and actionable things behind a paywall. And it's basically about what we can be doing to prepare for what is going to be an epic financial crisis and probably a political crisis that's just as epic, and maybe even a geopolitical crisis. So crazy times are coming. What can we do? And it turns out there's lots of things we can do. So that's what I talk about there.
A report from Citibank says they expect AI to replace at least 50% of bank workers. Is that a warning for every white-collar job?
Yes, it is. AI, by the way, it's turning out to be a little bit of a bust from an investment standpoint. So be careful with those AI stocks, especially NVIDIA, but all the other ones too, because they might be doing a .com thing here. But AI itself is going to be very consequential. And one of the ways it's going to be consequential is it's going to automate a lot of different jobs out there. And those jobs are going to be the ones that require thought rather than just physical dexterity. So that's a huge sector that hasn't been automated yet, and it's going to be. And that's going to be just a fascinating thing to watch when, people with college degrees who 20 years ago could have stepped right into something that was a lifetime of job security are going to find that things are very different. And I'm not sure how it's going to play out, but I think robots and artificial intelligence automating a lot of jobs, those are one of the big themes for the next decade.
I won't use an automated checkout system because I don't believe in working for free because I'm replacing a person. And the European Union is looking at a robot tax. If you replace a worker with AI or a robot, you have to pay a special tax to help support the person you just laid off. Any thoughts on that?
Yeah, that's going to be part of the debate, because there's going to be a relative handful of people who own the AIs and own the robots who are going to get incredibly rich from this, very possibly, at the expense of the people they put out of work. So there's going to be some kind of a social contract thing that has to be devised where the people who own the robots are taxed, and that money some way, somehow flows to the people who are put out of work by the robots. I don't know how it's going to play out, but it might be some kind of UBI, Universal Basic Income Scheme, which as a libertarian I just hate conceptually. But it could be that that's the politically expedient thing to do. We'll see. It's part of the debate over automation that's going to be coming soon.
Or I could see kind of a Soviet-style system where you, quote, have a job, but all it means is you push a little dust down the street and the government sends you a check. But you haven't really done anything productive.
That's your universal basic income. And the only question is, do we pretend to have people work? Or do we just send them stimmy checks while they sit at home? I don't know. I don't like any part of that process. And so I think, a much better idea is massive retraining of people who lose their jobs for the jobs that remain, because there are plumber shortages and electrician shortages, and anything that requires a combination of skill and physical dexterity and critical thought is going to stay a human job for longer than a lot of things like paralegals and things like that, where it's basically all thought. So if we can retrain people to be car mechanics and plumbers and electricians and other things related to home building and construction, then maybe we make a transition in pretty good shape. Or home health care, We don't at the moment have robots that can handle skilled nursing for people who need it, and a growing number of people need it. So that's another thing where there's a huge shortage of people. And nurses, there's a huge shortage of nurses, and you cannot replace a nurse with an AI because it's an incredibly complex job. So there's stuff that we can do that is productive work, that improves the people around us, and that will still be there as a job 10 or 15 years from now. So if we make a transition in that direction, we'll be a wise society who maybe manages this process in pretty good shape.
John, thank you so much for being on This Week in Money.
Thanks, Jim. See ya.
My guest has been John Rubino, author of several books on the economy, including The Money Bubble. You can find him on Substack at Rubino.Substack.com. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Eric Hadik, and John Rubino. And thank you for listening. If you have any questions for the show or for our guests, you can send them to info@HowStreet.com. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at TalkDigitalNetwork.com. This Week in Money is a production of How Street Media Incorporated. Executive producer is Tom Allen.